quickly talk about the state of the industry, a bit on mining and exploration, due diligence, busts, technical studies, and tips and tricks to reading and interpreting news releases for your own investment purposes. Graphically, what we're talking about is how to avoid going down there, because everyone that goes down there almost never comes back. So we want to get out ahead of that. All right, so, well, it's been a tough time for metals sector. Nobody cares much about it, and I think that's really the problem. There's just no big fund, big money interest. They're all into other things and used to it. The seniors on the whole are down 6%, intermediates 2%, juniors 12%, and silver is off 19%, while gold is actually held pretty steady. And the NASDAQ, as you know, is down about 23% this year. Last year and the year before, it was really great for the mining companies. Prices were up, costs were stable. At $1,500 gold, majors generated about $71 billion in free cash flow. $1,850, that comes to about $113 billion in free cash flow to the major mining companies. Copper miners as well have done well. And last year in the junior sector, about $1.8 billion globally was raised in 129 IPOs and $2.4 billion in equity. And a lot of that went into the new battery minerals and stuff. Excuse me. Canadian financing's $5 billion hard, 1.7 flow through. Historically, the miners are cheap on an enterprise value to free cash flow basis. However, this year, inflation has hit and the margins are being squeezed across the board. And Joe talked about that yesterday. So what are they doing with all this cash? You can see where it's going. $10 billion in exploration budget in 21. 38% went to mine site, 36% late stage, and only 26% to grassroots. And grassroots is where the new metal has got to come from. Most of it went into gold. You can see that. Nickel's a bit. And so how's it going in terms of discovery? Not so good. We've had a few the past couple of years, but on the whole, we are not keeping up with production. We're not finding and putting enough mines in production to replace what's being mined. If you think of the terms of the Carlin Trend in Nevada, it's produced in the order of 90-something million ounces. We produce something in the order of 90 million ounces of gold a year. So effective, we've got to find and put into production one Carlin Trend a year. Same goes for Bingham Canyon down out of Salt Lake City. We're burning through one Bingham Canyon per year, and we're not replacing that. And what do they need to find? Well, they need to find high margin, high grade deposits. What this shows is the grade of the companies on average versus the share price and such. So you can see that the higher grades get the highest valuation. That intuitively that makes sense. We know that. That's what we need to find. And going back to how much has been spent, over a 20-year period, there have been 21 Tier 1 deposits found, about $20 billion in global gross metal value. And work done by basically Ken Orland. They put out a fantastic little video on the business model project generator. They estimate that it costs about $1.5 billion per Tier 1 discovery. And that's over a 20-year period. And this kind of lays out where those are that they highlighted. All right, so what's the primary reason for busts? Number one is certainly resource estimation. It's a very difficult process and business to estimate a resource. Consider you're looking at a piece of core about yay big, you're cutting that in half and then reducing that half down to about 30 grams and sorting that out for assay. And that 30 grams has got to represent all the rock between here and say the windows out there or more. So you're interpolating this much data over that much space. Very difficult. Dilution, that's a real issue. We'll talk about it later. Metallurgy, the deeper we go for deposits, there's generally metallurgical issues come into effect and that sort of thing. So it's getting tougher and tougher to recover the ore. Unrealistic studies, we'll talk about that. Social and environmental issues have become bigger and bigger problems. And easy money. The bankers and brokers make money selling you stock. So they're always on the positive side. So keep that in mind. And here's a short list of disasters. You can take a picture and add your own. All right, let's talk about some of the 43-101 studies. What I find remarkable is this chart here shows in brown projects that are built in production, kinks have been worked out, and what their all-in sustaining costs are. In blue, those are the ones that have not been built. And it's remarkable that all of those are essentially have a lower all-in sustaining cost than the ones that are in production. I would be very leery of that sort of thing. Here's a good example, I think. Spanish Mountain, they did a pre-feasibility study. It's a project in BC. Came up with at a 5% NPV of $655 million, IRR 22%, CapEx $461 million, plus another $243 million later on. They got 2.3 million ounces M&I at a recovered grade of 0.63. This is a sulfide deposit in a complex geology, highly variable mineralization, several stages of processing, yet their all-in sustaining costs are lower than the industry averages. Again, not built. And that's what a poor study looks like. After 15 years, they've sunk $97 million into this, and the current market cap is about $55 million. And I threw Sprott in there. I'm not to knock him. The guy's great, but he invests differently than we do. He's of the opinion that gold is going to $10,000, and he can put $100 million scattered across 70 companies. That's how he does well. He knows a lot of them aren't going to work, but the few that do work. So I guess my point is, you want to know what your, say, guru or expert really is, his investment philosophy, what he can do versus what you can do. Okay, what can you tell from a drill pattern? I think this is important, and I just pulled this up yesterday from Orzona out there. So here you can see, this is a plan map. Those are all the drill holes lines, and you can see clearly that they have a good idea of what the geology is doing, what the structural controls are. They found the structure, they're drilling it out. They know what this thing looks like. And this is what it looks like in reality. Let's take a look at this one. What can you tell from this drill pattern? This is Sirius. What you can see is the dark lines are the more recent drill holes. The lighter ones are others they've drilled all through there. And take a hard look at all the different directions these are going. It's clear that they don't understand what's going on. And maybe it's not, and I think it's because it's not a very good deposit. It's just scattered little bits and pieces that don't hang together. There's poor continuity. And this is despite intersections announced of like 80 meters at 3 grams, 16 at 3 or 4, 1.1 at 97. Another thing I noticed, you want to keep a track, is this a low-grade deposit, disseminated, or is it a high-grade vein deposit? It's one or the other generally. And if you start seeing narrow intersections of high grade and in the same release long intersections of low grade, what is it? And you've got to think of that in terms of how are they going to mine it? Is it that all comes into it. It's one or the other. And smearing, there's been some smearing here. We'll talk about that. And this is what their deposit looks like. And they announced 1.9 million ounces of 0.65 in 2020. Grade smearing. This drill hole calculator you can get to from our website, explorationinsights.com. It's a link, and this is really handy. You can plug in A long interval, in this case, we've got, 573 meters grading 1.21 grams. That's a nice hit, right? Included within that are 3 meters of 131 grams. So you put those numbers into the spreadsheet there and calculate what it comes out to. And at the bottom, what you've really got is 570 meters of half a gram and 3 meters of 131 grams. That completely changes your idea of what this deposit is or could be. Yeah, you can use that. I use that a lot. And this is what that looks like. Right? Not good. Okay, let's get into some real detail. Narrow vein deposits. Here's a underground view of a deposit I looked at in Northern Ireland. The blue is pointing to the quartz veins. That's where the mineralization is. The green kind of outlines what you're going to have to mine to get it. That's your mining width, if you will. Excuse me. And in section, what we're trying to do now, okay, so blue is the ore, green is the waste. To mine this let's call it a 1.5 meter wide vein that averages 10 grams. But to mine it, you've got to mine another 1.5 meters of waste. So what you're really mining is 3 meters of 5 grams. So just doing that, you've dropped your grade by half. And so you've got to keep that in mind. What's going to be mined versus what the vein actually looks like. And that really decreases, that halves the value of the ore. And then you start throwing in internal waste. That's another issue. Many times along a vein, the vein is a structure that's a weakness in the earth. And so not only does the vein go up there, but you might get volcanic dikes or whatever. So it gets much more complex along there. And internal waste is a real issue. And it was a real issue here with Rubicon. You can see what happened here. Infill, they brought in $500 million on this. But it turns out the ore was not where they thought it was because it was a really poor resource estimation based on way too widely spaced drill intervals. More on the veins. This is from the Eleanor deposit. The blue outline is the original shapes that were used to estimate the resource. And the black lines, those are the drill holes going through this vein, if you will. And so that's how they modeled it. But in reality, the vein did all this sort of thing once it got down there and did the real details on it. So what that means is less ounces, more waste, and at higher costs. And this is sort of a theoretical one. If you take the indicated shape on top, which is just a straight vein, and then if it is actually a bit curved like that, what happens is you add 60%, just as much on something this minor, 60% more tonnage, 10% more ounces, yet 25% less grade. So again, grade down, costs up, too much waste. Okay, how about big open pits? How important is strip ratio to an open pit? What this shows is two sections through an imaginary deposit. The top one is just a vein, and if you're looking at an open pit, talking about an open pit mine, this is what you've got to mine to get to it. So this narrow vein in a flat topography, you've got 18 ore blocks, 380 waste blocks, so a total of 398 total blocks that have got to be mined, which gives you a strip ratio of 22-1, meaning you've got to move 22 tons or blocks of ore per ton of waste per ton of ore. If you assume $2 a ton, that means it's costing you $44 a ton to mine 1 ton of ore. On a more disseminated deposit, the second one down below there, you've got 130 ore blocks, 259 waste, 360 total blocks, which gives you a strip ratio of 3.5-1. Much better. So you assume, again, $2 a ton to mine it. That's $7 per ton of, or per block mined, or you can call it per ton mined. Big difference. It's actually more complex than that. If you look at that lower example, a lot of the waste has to be moved before you get to a lot of the ore at the bottom. So your strip ratio is higher. You can't just look at the strip ratio on the whole. You've got to look at it as it's sequenced. So a lot of times you'll see when you start seeing the best ore at the bottom of the pit, that's often not a good thing because it takes more money to get to it. Your initial costs are going to be higher. And often the deeper the ore, the less well it's drilled out. I've seen a number of times where the high grade at the bottom of the pit is related to just 1 or 2 drill holes. So these things you got to keep in mind when looking at these things. A spectacular hole doesn't make a good deposit. I'll go quick through this. Basically, drill hole in a project in Colombia, 270 meters at 1.2 grams. What that shows, the gray is the mineralized porphyry, if you will. And again, assume that whole gray bit is mineralized. Look at the strip ratio to get to it. You've got to move all that to get to it. And this is in a valley as well. So the deeper you go, the more you got to pull in from the side. And that's what that looks like. Gold Mining Inc. bought this and claim they've got a resource. Unrealistic targets. I see this a lot. Companies are out looking for things that, even if they're successful, it doesn't matter. It certainly doesn't matter the share price. Here's one I like a lot. This company is drilling beneath Lakeshore Gold's deposit. At 3.5K down, their property sits down there. So they proposed and drilled a 3.4 kilometer drill hole to look for a vein down there. And let's pretend they're successful and hit, 3 meters at 20 grams. At that depth, what's it going to cost to drill a vein out? How many holes you got to put down there to get to it? So even if they're successful, it's like, what the fuck? Sorry. And just graphically, from the CN Tower, 3.4 kilometers is clear up to what's that road? Davenport Road here, which is a long way out. And they're advised that the deep hole didn't hit anything anyway. What this shows is a schematic diagram of all the different types of deposits that can be associated with an island arc setting or a volcanic setting. And all the red on there is different deposit types that we could have in a volcanic setting, like in the Andes, for instance. In reality, that's what it looks like. This is from a project I looked at on the backside of the Andes in Peru. And here's a aerial shot of the Andes, the high Andes. Each one of those little brown squares, or diamonds, I guess, is a volcanic center. And each one of those has a bit of alteration associated with it. Each one of those could host some sort of gold or copper deposit, but most of them aren't gonna. So there's no shortage of anomalies in the world, but there is a real shortage of deposits. And the key, especially for a junior mining company or someone investing that, is to know when to quit. Most don't. So why bother with the science and due diligence? The odds of discovery are very low. Rule number 1, don't lose money. Get out ahead. When things go wrong, get out. Find the fatal flaw as quickly as possible. And ultimately, reality wins out. And here's why you want to keep track of these things. All right, summarizing. You want to efficiently, as quickly as possible, kill it. Find the fatal flaw. Know the funding requirements. This exploration costs money. They don't generate anything. So find the funding requirements. Know when to quit. What do we need to see to continue, or more importantly, to quit, to get out and sell? Know the economic parameters of what you're looking for. High-grade vein versus a big porphyry, and the geologic patterns. What's it got to look like to be real? What are the social environmental limits? Is successful meaningful? And ultimately, does it translate into a share price increase? If it doesn't do that, there's no point, at least from our perspective. All right, so that's the end of it. Joe Mazumder writes Exploration Insights. I work with him on it, but he's the boss. And if you don't want to do all that due diligence, come see us. And if you're interested, send an email to us on the website, and we'll send you one sample copy of the letter. And with that, I'm done. Thank you.